Jeremy Grantham has warned that the S&P 500 is going to lose up to 60% of its value, as he predicts a deep recession in the US in 2024. Grantham is a billionaire investor who made a name for himself with predicting the dot-com bubble of 2000 and the housing bubble of 2007, making a fortune from both economic crises. And he recently stated one should expect something pretty bad this time. We await to see if this follows the pattern of history or whether it is indeed that lovely creature, a new paradigm. But history is not kind to the new paradigm thinking. Grantham is known for making dramatic predictions, and he is calling today's stock market the biggest bubble he's ever seen. In fact, the famous bubble historian expects the S&P 500 index value to fall to at least 3,000 and has even stated that he would not be surprised if it falls closer to 2,000 if the wheels really come off. For context, on the day of making this video, the S&P 500 index is valued at 5,146, so Grantham's prediction of a decline of up to 60% would be the worst stock market crash since the Great Depression in 1929, when the Dow Jones Industrial dropped 89% from its peak. In this video, we will explore why Jeremy Grantham is convinced the S&P 500 stock market is about to burst and what you can do to protect and grow your money during such economically challenging times. So, how can we determine if a market is overvalued or undervalued? One of the most common ways to analyze whether the stock market is overvalued or undervalued is the Shilla PE ratio. The Shilla PE ratio is generally applied to an entire stock market index, most often the S&P 500, and is believed to provide an accurate measure of the value of an entire stock index as it is calculated over a 10-year period, so smooths out the short-term earnings volatility experienced by many companies. It also takes into account inflation, which can make a company's profits look artificially high in the short term. To understand the Shilla PE ratio, we must first understand the PE ratio. The price-earnings ratio, or PE ratio, is used to assess whether a single company is undervalued or overvalued by comparing its stock price to its earnings per share, EPS. For example, if a stock is trading at $10 per share and its earnings per share are $1, then the stock has a PE of $10 divided by $1, which equals 10. This is a very helpful metric to compare the performance of companies and to identify whether or not an individual company is over or undervalued. However, the problem with the standard PE ratio is it will reflect short-term changes in a company's earnings performance that could have been caused by big macroeconomic events, such as a market correction or recession, and not because of the company having strong fundamentals. It is therefore not such a reliable measure of a company's long-term value or of the strength or weakness of the market as a whole. And that is why Robert Shiller, a Yale University professor, proposed looking at inflation-adjusted 10-year earnings data to minimize the impact on earnings of short-term economic events. The formula for the Shiller PE ratio is current price divided by average inflation-adjusted 10-year earnings per share. In other words, to calculate the Shiller PE ratio, we need to look at the yearly earnings of the S&P 500 for each of the past 10 years. Adjust these earnings for inflation using the Consumer Price Index, or CPI. Average these values by adding them up and dividing by 10 to get the inflation-adjusted EPS, and then divide the current price of the S&P 500 by the inflation-adjusted EPS to get your Shiller PE ratio. A lower Shiller PE value suggests the potential for higher returns from equities over the long run, whereas a high Shiller PE value could suggest that a market correction might soon be on the horizon. So, how does this apply to the stock market right now? Well, at the time of making this video, the S&P 500 Shiller PE is 34.4. For context, over more than 100 years, the average and median Shiller PE ratio has been around 15 or 16, rising up significantly higher often before market crashes. This chart shows that the all-time high in the Shiller PE ratio was in December 1999, when the figure reached 44.19. just before the dot-com crash. Similarly, it reached a previous high of 31.48 in 1929, just before Black Tuesday and the beginnings of the Great Depression. It is for this reason that Grantham argues that corporate profits in the US are currently at unsustainable levels, creating a bubble that will soon burst. In his view, the so-called Magnificent Seven stocks, which include Apple, Tesla, and Nvidia, have accounted for virtually all of the S&P 500's gains in the past year. And if you took these 7 companies out of the equation, the S&P 500 would not be up for the year. It is this over-reliance on the Magnificent 7 stocks that leads Grantham to believe that the S&P 500 is currently overvalued. In addition to an overvalued stock market, Grantham also believes a series of economic factors will cause the American economy to contract fairly soon. For example, the US government is currently maintaining $33 trillion of debt following recent efforts to stimulate the economy and faces the prospect of paying huge amounts of interest to service the debt. In addition, a period of increased interest rates is creating immense challenges in the real estate and mortgage markets as consumer debt becomes more and more expensive. This all leads Grantham to believe that the upcoming market crash will be bigger than 2000 because it includes real estate and bonds, and that one did not. While this outlook may seem alarming, let's now look at some of the key strategies Jeremy Grantham suggests you apply to protect and grow your money during such economically challenging times. Strategy 1. Invest in non-US equities. Grantham has stated, to the extent you can, avoid the US. It's the most overpriced market. In his view, the stock market bubble is mostly concentrated in the US. As a result, investment opportunities do exist outside the US, most notably in Japan and the emerging markets, as both are considered cheap compared to the US stock market. There are a few different ways to access foreign stocks, including buying them directly in a global account offered by brokers such as Fidelity or Interactive Brokers. However, direct foreign investing comes with added costs, tax implications, and currency conversion issues, meaning it isn't always the best method to invest abroad for the average investor. Instead, you could consider investing in exchange-traded funds, ETFs, that will give you exposure to international markets without some of the complications of direct foreign investing. ETFs invest in a portfolio of stocks or bonds designed to mimic the composition and performance of a financial market index. Unlike index funds, you can buy and sell ETF shares just like individual stocks during the trading day, which makes ETFs very flexible. ETFs will typically let you target the exact geographies you want and will cover a wide variety of investment categories and markets, allowing you to manage some of the additional risk that comes with investing abroad. Good examples of ETFs that invest in a wide range of markets, excluding the US, are VXUS, the Vanguard Total International Stock, ETF VEU, the Vanguard FTSE All World X US ETF, and ACWX, the iShares MSCI ACUI X US ETF. All 3 ETFs invest in a wide range of countries including Japan, the UK, China, Canada, France, Switzerland, India, Germany, Australia, and Taiwan. For emerging markets, some of the top-performing ETFs in the last 5 years include IEMG, the iShares Core MSCI Emerging Markets ETF, and AAEM, the Amundi MSCI Emerging Markets ETF. Both ETFs invest in emerging markets such as China, India, Taiwan, South Korea, Brazil, Saudi Arabia, South Africa, and Mexico. Strategy 2. Buy American Depository Receipts. Another option to invest abroad is to buy American Depository Receipts, or ADRs. ADRs are certificates issued by a depository bank that represent shares in a foreign corporation. ADRs are listed on a domestic US exchange, such as the New York Stock Exchange, just as any domestic US shares would. Investing in ADRs is easy as they're available through US brokers, such as Fidelity or Charles Schwab. They offer US investors a way to purchase stock in overseas companies that would not otherwise be available, allowing you to invest in some of the most familiar companies in global business, such as Shell, AstraZeneca, or Unilever. To begin offering ADRs, a US bank must first purchase shares in foreign companies on a foreign exchange. The bank holds the stock as inventory and issues an ADR for domestic trading. ADRs are priced and traded in dollars, and any dividends earned are received in dollars, so the investor does not have to face any of the currency issues associated with buying foreign stocks directly. However, investing in an ADR may incur larger fees that are not charged for domestic stocks, as the bank will charge an additional fee for creating and issuing the ADR. 3. Focus on quality in the US market if investing outside of the US does not appeal to you. Then Grantham says it's critically important to take a good look at quality. In his words, the stock market is filled with individuals who know the price of everything but the value of nothing. In other words, there's a good chance that a company's true value may not be reflected in its price. As we discussed earlier, Grantham believes the S&P 500 is currently grossly overpriced and due for a significant market correction. You might therefore be wondering why we would still suggest investing in the US stock market in 2024? Well, the good news is that even with the challenges that currently exist, there are still US companies that offer great value. In Grantham's view, AAA stocks such as Walt Disney, Target Corp, or Coca-Cola offer an investor great value over the long term. For example, let's take a look at Coca-Cola. In Grantham's view, you don't want to own Coca-Cola. It's just too boring. But in the long run, Coca-Cola does very well. In other words, while other companies may have more innovative business models or operate in more popular, up-and-coming sectors that excite and turn the heads of many investors, investing in a boring company with an established track record and strong fundamentals remains the smart play to protect and grow your money, particularly during a market correction. Grantham sees Coca-Cola as a strong long-term investment as it offers less risk, less debt, and less volatility than many other US companies, and yet it still consistently outperforms them. So, there you have it, the strategies you can follow to protect and grow your money, even if Jeremy Grantham's prediction of a significant US market crash materializes. Whatever strategy you decide to take, you should always consult a financial advisor to make sure you find the approach that is best tailored to your financial goals and attitude to risk. While Grantham has many convincing reasons why the next big US market crash is just around the corner, the super bubble in stocks, housing, and commodities he declared at the start of 2023 is yet to burst. And while he did successfully predict the dot-com bubble of 2000 and the housing bubble of 2007, he has openly stated in the past that he is often early in identifying investment themes and tends to be painfully wrong in the short term. Only time will tell if his latest prediction comes true or not. That is why, when making investment decisions, it's crucial to remember one of the most important rules about investing. It's not timing in the market, but time in the market that will make you wealthy. Ultimately, you are an investor, not someone who can predict the future. If you found value in this video, please hit the like button. Don't forget to subscribe and click the bell icon so you won't miss out on more content. Until next time, keep building your wealthy life.